think we are live, ladies and gents. Good evening to you. And Christmas is in full swing, even though it's not even December. Lights are out. They've been done any Christmas tree shopping yet? Whether you've loaded trolleys up with unnecessary decorations, whether the decoration bill has been astonishing. But yeah, we're getting there. Markets are just coming off Thanksgiving. If you're tuning in from the US, not many of you, but if you are, happy belated Thanksgiving. And then we've got Christmas coming up. Poor turkeys, it's not the season for them, is it? Okay, so this webinar today will be the last one of the year. It's been good, enjoyed them. Hopefully you have, and I really want to go out with a kind of really high quality finale, if you like, give you some really actionable stuff to take away and deploy in your trading, some things to think about, things to consider. And even if this year wasn't the best year for you trading wise, sometimes reframing it and saying, okay, well, what was I like last year? This time last year, how was I trading? Rather than always looking at P&L, you can say, hang on a second, my behavior last year, my discipline wasn't very good. I didn't even have a strategy. All this type of stuff can be things to look at as a comparison tool rather than P&L, and using that as a motivation momentum to go forward. Now, it's not the end of the year yet. Still got a few more weeks, of course, but we're traded. We can't help but think, what's Q4 going to look like, how we're going to end the year, what sort of number we're going to put up. So yeah, just bear that in mind, depending on where you are in your journey. Okay, so today, Scalpers Edge Part 2, two-part webinar series. You can go and check out Part 1. This was 2 weeks ago now. You can go and look at it, tradersmastermind.com. If you scroll down to webinars, there's a recording of it there and some more sort of added context. Before I go into this, of course, the disclaimer, you know what it is, ladies and gents. It's a very risky business, this, spread betting, CFDs, complex instruments. Very risky, high risk of losing money. I know most of your experience, you've been here many times before, you understand, the rules of the game. But if you're brand new to trading, then honestly, please understand what you're getting involved in. Please understand the nature of the product. And there's demo accounts out there. You can open a demo account. Pepperstone got a demo account. Just get used to things. If it's interesting you and you say, you know what, I want to get involved in this, please start off with a demo account. I hate to hear stories of people who didn't get what they were trading. Fine, you trade, you lose money, you learn, you improve, then eventually kind of things start working. That's great. But I don't like to hear when people don't really know what they're trading. So if that's you, I know it's not many of you, but if it's just one person listening who goes, I don't know what I'm trading, then go and do some digging, go and do some research. Loads of free content out there that will help you, and you play around demo account first. Okay, so with that out of the way, the big boys and girls are still on the show. Let's get going. Nice quote I found here from Paul Tudor Jones. This was, the illusion has been that you can follow a set of rules in a market. The reality is that you need to adapt to the market's constantly changing state. I don't think I've seen this one before. And this is a great quote because, yes, whilst rules will keep you focused and those boundaries will keep you aligned with what you're trying to do and stop you getting seduced by other things and other markets and other ways of trading, ultimately it's you as a discretionary trader, as a scalper, your job is to have a look at the market conditions, adjust, adapt, and tune your strategy and develop your strategy and constantly be evolving. And go off topic slightly, you'll find a strategy that works and it's effective and it's doing well for you. Like, this is great, this is great, this is great. Don't sort of sit on your laurels too much. At some point, it will stop working. The market will shift conditions. It will shift into a different environment. So always be working on additional strategies. Always be learning, studying, marking up your charts. It's very easy to fall back into a false sense of security and go, everything's working, I'm a great trader, the best. But the market will change. The market always changes. So great little quote here from Pt.2. Just always be aware that you need to adapt to the constantly changing state. And listen, last month, massive bull run, quiet because Thanksgiving came in. You start sort of buying breakouts last couple of days, it's not going to work for you. You bought breakouts a couple of weeks ago, you're doing very nicely. Really kind of rough example, but you get the idea. Okay, so today, last webinar, we talked about risk management tactics, mindset tips, price clues and momentum strategies, and also a reminder, guys, this is just for information purposes. I'm not giving you any advice here, and you should do your own research into the strategies I share, and I want to give you seeds and little ideas that go, right, that's interesting. Let me learn some more about it. Because I had this discussion with a trader the other day, and there's so much power behind you digging into a strategy yourself and working out, hey, that looks great. I've observed that. Now I'm going to deploy it. So that's sort of the process really is I show you some stuff. You go, don't like that, don't like that, do like that. Go and look at your charts, go back, see, observe it in real time, and then decide if you want to deploy it into your trading methodology. Okay, today, exhaustion plays, mean reversion, pre-new scalping. Little idea for that. Algo Party, I call it. So scalping this liquidity. Well, more on that in a moment. Announcement trading, reversal rules for scalping, the closing dance trade, which I call it, and then training drills and some sort of observations about scalping in general, which hopefully you can take away and deploy anywhere you want to trade. But I've got some sort of frameworks here that I think will help you. Very quickly, if you haven't signed up for my daily email yet, then what are you waiting for? People like it. It's valuable for you, helps you. 7:30 a.m. every day, it'll hit your inbox. Growing nicely, some great feedback. It's free, obviously, and go and check that out because I really do think you'll like it. The other thing I want to mention is I know many of you have Trading Plan Pro. We have finally got the feature. The discipline tracker is live. So if you log into your app, Trading Plan Pro, scroll down to discipline tracker, you can then deploy the discipline tracker, improve your good habits, build your good habits, try and get rid of the bad ones, and kind of improve month to month. So check that out because I know many of you already have that. And if not, again, go and check it out, see if it's something that's interesting to you. Okay, the meat. Reminder, I don't have the answers. I'll share with you ideas and thoughts. Do your own research. Things take time. Implement change, stick to it. Observe the results, make those small course corrections. Do not give up. Okay, scalping edge. So I want to talk about this for a moment. By the way, I'm going to have time for Q&A at the end. Check my clock. We're good. So any questions you have, feel free to stick them in the chat. So scalping is your ability to read the short-term supply-demand imbalance. And what I mean by this is wherever you are deploying scalping, whether you are at previous highs, whether you're at lows, we'll talk about this in a moment, whether you're at the open, whether you are in a specific kind of strategy rule set that we'll talk about again in a moment, your really comes down to one thing, your ability to read that supply-demand imbalance on a very, very short term. So if market is running strong and we've got lots of buys, prices moving quickly, pace of the tape is strong, market movement is quick in a very short period of time, then your job as a scalper is to spot that, calibrate yourself to that very quickly, and then when it stalls, you take the short, and if it carries on, you're out. That's where you've got to be quick, and you've got to be really, really brutal with cutting the trades that aren't working. And if it's right, it snaps back, there's your scalp. Now, do you turn that scalp into a longer term day trade? That's up to you, that's your decision, and if there's a bigger trade in play, then great. Or do you just trade that quick liquidity vacuum of market running very, very quickly? Someone is very, very time sensitive rather than price. Talked about this before, and I will talk about it again because I think that really gives clarity in your mind. Like, hey, if you want to get involved with a trade right now, you want to buy something right now, you don't care what price, and so you'll pay more and more and more. So an institution will come along and say, I need to get into this market right now for whatever reason. There are many reasons why they might want to do this. They will then sweep multiple layers of offer, causing the price to lift higher, versus someone who is very, very price sensitive but doesn't care how long it takes to get filled, or if they get filled, they could just sit there, work an order, and that's when we have kind of most of the time market chugging around. When you get a lot of participants that are very, very time sensitive, or one big participant that's time sensitive, or the stops triggered, we talked about stops before, you know, it's a retail getting triggered, that's, again, a time sensitivity. Get out whatever price. That's what you're telling someone when you put a stop order in. So when we see that as a scalper, if we can take the other side of that trade, then there's an opportunity for that supply-demand imbalance to right itself, even on a very short-term basis. So the spring stretched, just come back again. Scalping is just trading that, just constantly. You know, we're looking for, okay, yes, you can roll them into day trades, and I think that's actually a good edge that you can deploy. But if we just keep on scalping, which we are at the moment, it's that opportunity, that short-term opportunity, only at specific points in time. And cutting trades quickly is super important. I think it's the one superpower you must have as a scalper, because like the example I'd said, if the price is moving up strong, pauses, you see this pause, everything looks right, you hit it short. If it's carrying on, you do not want to be sitting there hoping you're gone, you're done. You're hoping that you can really read that turn, read that pause, read that pace of the tape easing off, and then coming lower. And preserving focus, which is, again, a mistake I see a lot of scalpers make, trying to just get involved in everything all the time. There isn't edge there all the time. We just got to face the fact there's no edge all the time. The edge comes at specific points in time, specific opportunities, different time of day, specific levels. That's when the edge is a scalper. When other participants have time sensitivity, not price sensitivity, and there's a supply demand imbalance, that's the edge of a scalper. Anytime else, you're just guessing, or any other time, you're just guessing and gambling. Okay, so let's go through some neat little approaches that I can share with you, and you can kind of go ahead and have a look for yourself and see how they work in the market you like to trade. Okay, so I love the VWAP. I think it's one indicator that stayed on my chart for 15, 16 years or so out of my 20-odd year career in the game. I just think it makes sense, and it's not a webinar on VWAP. I think I've done one before. I've done before probably. If I haven't, I definitely will do one at some point. Volume weighted average price, that's institutional benchmark, right? Algorithms run off it. Institutions, if you give someone a big order, if you're ringing up your broker and saying, hey, I want to buy 1 million shares of this company, assuming there's liquidity to do that intraday, they will use the VWAP as a benchmark and say, right, we bought you that and we got the VWAP price. Great, good for you. We beat VWAP price. That's why very often when price comes back to VWAP after being extended for the high side, there's a lot of buyers, because algorithms are saying, hey, this is value. This is good for our clients. We're going to start picking up more stock, start buying. And so that's why VWAP, I believe, works well. But there's not a webinar on VWAP. Let's not get sidetracked. So what we want to do pre-news is take advantage of fading extensions away from the VWAP. Now, why pre-news? Well, think about, you're an institution, right? You're a hedge fund. You are a money manager. You're a big trader. And not a scalper. You're someone who's kind of trying to deploy large amounts of capital. Now, if you have something like CPI, FOMC, ECB coming up, that's an important news point, you're not going to deploy any capital before that. You're just not. Why? Well, you would look foolish if it went wrong for you, and you're going to look like a gambler. There's no reason for anyone to deploy large amounts of capital before a news point. Obviously, if someone's got insider info, that's different. But assume most people haven't, because this stuff is, it's government level, etc., etc. No one's going to deploy large amounts of capital, which means that we're not going to. And again, it doesn't always happen. Nothing's never certain in trading. But very often, if price moves away from the VWAP, it's just general ebb and flow, buy and sell, just supply demand shift. There's never really a big trend day before Fed or before CPI. Now, I say that, and as I say that, I can, if you hear me just pausing, I can picture in my mind some days where we have done that. So it doesn't always happen. Of course it doesn't. But on the whole, generally speaking, the VWAP acts like a little bit of a magnet, because everyone knows there's an announcement coming up, and let's make the assumption that VWAP is the value, if you like. We're not talking about point of control or anything like that, or any sort of volume profile, but let's assume that's believed to be fair value at that point in time and the mean. Then the price, the expectation is that as we extend away from the VWAP, that's going to act like a magnet and pull price back in before the announcement. Because most of the time, and I can think of times when we don't, but most of the time, I believe that we are at or very near to VWAP just before the announcement. Why? Because just what I said, no one is willing to rather put lots of money on the table and start bidding something up on the expectation the price is going to rip higher. Like, if that was their thesis, they'd have done that before and be positioned. They wouldn't just be doing it in the last hour, just scrabbling away to get stock or to get contracts. They're not going to be doing that. Same with the sell side. So we have this ebb and flow back around the VWAP. Think of it like a magnet. So our idea as a scalper is to say, hey, if I align with that thesis, if price is above VWAP, I want to stay short or think short. I'm not talking about triggering short yet. If it's below VWAP, I want to think about triggering long. Okay, we know the announcement's there. Everyone knows there's an announcement there. Everyone's watching it. Everyone's waiting for it. It's something that's great, and everyone knows it's happening. So we know it's a certainty. Okay, so as we start to extend away from the VWAP, now we can play the game of, right, if we see a signal, so our filter is we've moved away from the VWAP, our trigger now becomes, hey, if we see a flush bar to the supply demand imbalance. Remember, we talked about supply demand imbalance on the short term. If we see someone who is very, very, very time sensitive, not price sensitive, on a very short time frame, and we're away from the VWAP, that might be a reasonable place to take the trade. So I'll show you some chart examples in a moment. But if we imagine we're extending away from the VWAP, price is extending higher, flush, movement coming in, bid, and we're already away from the VWAP, and we've got announcement coming up, that might be a scalping opportunity. Now, you decide just to grab 10, 15 ticks, maybe you do. Or do you hold for a rotation back to VWAP? Maybe you do again. But this webinar is about scalping, and so we'll stick to the fact that you're looking for that kind of edge, the edge, you're stacking layers of edge, right? Expectation that VWAP is going to pull price back in like a magnet, number one. Number two, edge, that short-term supply demand imbalance going against you or going against that VWAP even further. Number two, and kind of combining those and saying, right, I can read that pace of the tape stall, I can get involved in that. Some chart examples maybe will help to explain this a little bit better. Okay. All right, so I grabbed this one from a talk I did for Pepperstone years ago, actually, and this was a great sort of example. I've got other recent examples to show you as well from the past week. So, but the reason I want to show you this is because this is it in a nutshell, right? This is the Dow. We had Fed coming up at 7 o'clock UK time, marked with the far right red vertical line. Middle vertical line is the US Open, 2:30 UK time. Left vertical line, red vertical line, 8 AM is the European Open. So these three areas is really good visual. This Europe opens, market rotates lower under VWAP, back above VWAP, tags VWAP, pushes higher a little bit as we start get chugging, and then comes back to the VWAP just before US Open. No one's getting too excited. No one's deploying large amounts of capital. Off we go. US Open. Stocks are now driving the Dow, of course. So market pushes up, VWAP, down VWAP. You see how VWAP is such a key, important player in this. Player, it's not player at all. It's an important level to be watching. And even when we get that extension sort of coming into the UK close at 2:30, European close, 4:30, market then rotates back to the VWAP, overshoots a bit, and actually we're very, very close to VWAP. Yeah, we're not actually on it, but I think 15 minutes before, 20 minutes before, we were a couple of ticks away from it. That last little candle, just we were coming into 5, 10, 15, 20 minutes before. So we're almost there, and then we kind of, when the data came out, we were a little bit above VWAP. So the point is this, is that this is something that repeats itself time after time after time. It's the rotation around the VWAP. Now, you might be saying, Mark, hey, but this isn't, how do I scalp this? Well, let's look at it a little bit closer. So recently, CPI, 1 minute chart of the Dow. I'm going to show you this because it's such a big number. We're not bothered about the number at the moment. Forget about the number. We just know there's a number coming up, right? In this example, if you were trading it, it was that start of that massive run because CPI said, oh, inflation's sorted out, blah, 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 blah. Forget about the reason. Everyone knows CPI is coming up. Everyone's got their eyes on CPI. It's an important number. It's an important kind of barometer of the economy at the moment. All traders are watching it. Fine. We know that. Tick. Okay. We also know that prices tends to oscillate around the VWAP for the moments up until that. Tick. Okay. So let's zoom in a little bit. That was a big move. You can't see what's going on as much. So let's zoom in. So this is Death's chart. Zoomed in. I've stopped it just before we had the CPI number so we can see what's going on. Okay. Example, when we're looking for reversals, we're looking for things like exhaustion candles, people who are time sensitive, not price sensitive. So as we break through this low, we had a little bit of exhaustion candle. It didn't follow through. Great opportunity to consider along back to VWAP. And you might be saying, hey, and by the way, this concept of ignition bar that I think we've talked about before, larger range than average over the past 10 days, very, very useful. If you're not an exhaustion trader and you like to see momentum in your direction, then something like this, where it starts to pick up in your direction, you've still got the VWAP as a magnet, that's great. There's loads of other examples on this chart, but I wanted to just pinpoint those two. You can see how we have this constant behavior of the market oscillating around the VWAP. Here's USD JPY, data coming out, spike massively lower. Let's zoom in. Same type of thing. Momentum candle back in the direction. This is a little bit trickier because we extended. But if you're patient enough to wait for a trigger and your thesis is, I think we're going to tag the VWAP, I can't imagine us sort of sitting it here at lows for the data. Maybe it's a little bit early, maybe you don't want to take it, fine. But if yours like, hey, we're probably going to come back to VWAP, the likelihood is we're going to rotate back to VWAP before data. And if that likelihood is true, and I believe that to be true, then I want to be taking any signal that gives me an indication that we're either exhausted or we've got momentum back in the direction. And so looking for these ignition bars, looking for these exhaustion bars, you know, whether you scalp them out very, very quickly and be a scalper, fine. Whether you hold them for a little bit longer and look for a move back to VWAP, fine. You know, or the other alternative, you scalp with that direction. So once the move has started to go your way, you're buying the pulses coming out into the pauses. We talked about this 2 weeks ago. These drives, pause, Maybe you just take the drive. You come out, you wait, you go again. Now, I think you can trying to get too clever sometimes, but this is a pattern that, you know, is often repeating and is worth exploring a bit more. Okay, so Algo Party. What time? We've plenty of time. Good. Algo Party. So the Algo Party, I was going to cover it, and I thought, you know what? This is not right to cover this. Why? Because I think it's too much open-ended risk, right? I don't know who's on the call. I don't know experience levels. This is really, really sort of high risk stuff. And actually, also to be honest as well, this is not something that has been that effective at the moment. It's not something that you can deploy. I don't believe you can deploy at the moment. It will come back into play. So I'll give you the kind of overall idea for it, but maybe we'll do a deep dive on this later on, because at the moment, no point, because data is moving the market. You want to do this at a time when data comes out, but ultimately it's not market moving. So we have spells like this many, you know, months ago, years ago, where data is still coming out, but no one cares because interest rates aren't moving, inflation is not budging, nothing's shifting. And so you very often get these kind of spikes one way or the other that move up, move down by a certain amount, and they're very, very fixed. Often you can go back and you can kind of do some research and work out what these sort of brackets are, and you're fading a move for a snapback. So I didn't want to cover this today because I thought about it and thought, you know what, at the moment, this is just not a thing to deploy. And, you know, the more you sort of cover something, I want it to be something that's valuable to you right now. So we'll come back to that in the future. But Algo Party is bracketing the trade. Okay, something that you could do and is much more structured. And by the way, the Algo Party, when you're bracketing the trade, the idea is that, you know, most of the time you're going to catch those levels. It's going to snap back in. The one time you don't and get surprise news, yes, you lose, but the structure of the trade and how you structure it is that even when you do, it's okay because the majority of the time you're catching that snapback. But we'll maybe discuss that in another webinar. I'm going into some detail on that. And announcement trading. Okay, so this is a very, very kind of structured way to trade it. There's a very fixed risk on this. If you like your fixed risk stuff, if you like to trade knowing where your stop is without having to second guess it, this is great. So what's the overshoot reversal trade? So very often, and ironically, we haven't had this the last few chunks of data, but it's had positive data that's driven the market higher, as we saw. But it doesn't mean that you can, you know, completely mothball the strategy. Sometimes strategies gather a bit of dust in the drawer, and you're like, don't worry, pal, you'll come back, don't worry. You know, and then you start getting back into the swing of it and the conditions change, like Paul Tudor-Jones was saying at the beginning, and you dust it off. You're like, come on, out you come. I haven't seen the strategy for a while. Let me remind myself of the rules. So it's one of those, right? It's not, at the moment, we've had plenty of drives and no many reversals at all. But when we start going back into that environment, this is not a bad thing to consider. Okay, watch for an knee-jerk reaction to the data, frame the move with a fib tool, trade in the direction of any reversal, trading a very tight stop. Let's go into a bit more depth. Okay, so this is when data comes out. Data comes out, 30-second chart, spikes to the high side. Now, you're then using the fib tool on MT4, MT5, TradingView, whatever, and you are saying, okay, and it doesn't have to be a fib tool, by the way. All we want to do is find the 75% retracement and the 50%. And some people flip it around and go, well, it's the high. It's 3/4 of the move back from high to low. And what we're doing here is we're saying, let the market run, let it run, let it run. When it puts in a high and starts to rotate back, we go, okay, put a low in, put a high in. As we start to then break through the 75% level, we're looking for a one-to-one trade. Is that sexy? Maybe not. It's something I feel has got a higher probability, but it's obviously got a lower risk reward. Your target is the low, or if you're trying to be clever, scalping it through as we flush. We talked about that. You know, when we're going through lows, all people along where they're going to have their stop under the lows, you can kind of feed it into those sellers down there. But you're shorting here as it breaks through. You're coming out as you come through the low, and your stop is at 50%. So it's a nice, structured, easy trades to deploy. Yes, it's quick scalping, but you're here to see scalping strategies or potential scalping strategies. So this is one of them. Same again, we're on cable here, 30-second chart, scalps up, you put your low, you put your high. As you come back through the 75%, there's your short, your stop is at 50. And again, you've got to be like any scalping rules, if it comes up and hits that 50, you're gone. But very often the theory is we shoot off the upside or we shoot off the downside. Fine. Sometimes that's so quick and so it's like everyone gets carried away. By the time they digest the information, the bigger money's now hitting it back to where it was, or maybe get a full scale reversal, maybe we kind of oscillate back. So very often you get this, if it's going to go all the way back to 75%, chances are it's going to go back all the way. And so the idea of this strategy is to grab that little chunk. You might be like, oh, Mark, what about all this stuff here? Fine. If you can see some way of getting on board that, that's great. But this is a very methodical way. You've got time to put your tool on. You've got time to know where your entry is. You've got time to know where your exit is. You've got a stop is, and your exit. You can frame it and be ready. You can literally have a stop entry order in, stop order to bracket that, and a limit order there. Or if you want to be clever, maybe a limit a little bit lower and start to play the game of where do I see the flush end in and try and squeeze a bit more out of the trade. Or there is the chance that you do a full scale reversal and you drag it down and you kind of trail it that way. Plenty of opportunities with this. But what's nice about it is it's very structured. It's very easy to set up. And one thing is, right, that, you know, a lot of strategies, they're very good at keeping you out of the noise. Like, so if you're a trader who gets sucked into choppy markets or gets sucked into data, having a strategy like this that's very systematic, that you can trade and you can say, right, I'm not going to get involved in this. I've got one play I'm looking for. After that, I'm looking for something different. It keeps you out of getting caught in all this. You're like, hey, if it moves up and reverses, I'm getting short the 75, I'm covering this, I know what I'm doing. You know, it's something that's very simple and easy to deploy. And sometimes that helps you avoid getting caught in, you know, all this stuff and buying this and doing that and the other, and having, you know, going full discretionary mode rather than having, you know, a very, very easy to follow system. But like I said, at the moment, we're getting rips to the upside. Fine, we won't forever, and this will come back into play. So keep an eye on it, go back, do some research, see if it's right for you. Okay, next one. How long we got? Okay, we've got some time. Closing dance. As price is coming to the close on a range bound, got VWAP again. I love the VWAP. Here she is again. On a range bound day, very often we will close near to the VWAP. So just like those of you who know me, right? Those who know me, who've been, you know, trading with me, or know how I like to trade and how I look at the markets. You know, I like to use time. In other words, I like to know if everyone knows a level or a time of day. That's important. And the close, if we're talking about an equity market, is great. You know, everyone knows that. Whether you're trading a forex pair, whatever, everyone knows the equity close, right? And so same with the data. Everyone knows when that's coming out, whether you're trading forex pair, whether you're trading an index, whether you're trading a commodity. Everyone knows it. And when everyone knows something, everyone's it's almost subconsciously or consciously operating towards that target, right? They know the close is coming. They know that data is coming. All the participants are aware of it. And it's a very unique time in the market where every participant has got one eye on that going, I might not want to be in the market during that time, or I might want to make sure my orders are done before that. Everyone knows it, right? For whatever they're trying to do. So when price has been oscillating around and we have a range bound day, very often we're going to close near to that VWAP because that's considered value. That's considered a fair price. Buyers and sellers have agreed that that's where most of the trade has been done. And yeah, is it completely accurate all the time? No, but it's a good thesis to have, because if price has kind of gone away from the VWAP and it's making its way back to the VWAP to the close, you can then reverse engineer the trade and say, hey, actually, I think we could close near the VWAP. We're chugging towards it. There's a little scalp opportunity there. But the chances of us maybe picking back up and retesting highs, quite slim. That's your thesis anyway. So if we start to rotate back to VWAP, the close is coming, you've got 30 minutes to go, it might be a good scalp trade. Hey, I think we're at least going to be tagging the VWAP before the close. There you go. There's your thesis. You jump on momentum, or you jump on, you know, pause or take pause, whatever it may be. Okay, so these are sort of some of the broad rules. We'll look at some examples in a moment. If prices touch the VWAP multiple times in the day, so ping-ponging back and forth, not doing it on a trend day, doing a range-bound day, rotational day, price moved away from VWAP with 30 to 60 minutes go towards the end of the trading day, then I think there's a scalp opportunity that does sometimes present itself on a rush back towards that VWAP. Here's an example. NASDAQ, I think I've put the futures chart here, but NASDAQ futures, right? Same if you're trading the CFD product or the spread bet product, fine. Multiple touches of the VWAP throughout the trading day. It's acted as resistance, acted as support, fine. Now, as we start, this is quite an exaggerated one, which was pretty recently, which is a good example actually. As we start to come 30 minutes before the close, selling kicks in. Selling, momentum, big momentum coming in, unusual bars. And if your thesis is, hey, I think we're going to at least tag the VWAP or close very, very near to the VWAP for the end of the day, then that's a good opportunity to take advantage of that, right? You're saying the VWAP is a magnet still. I want to trade that. I want to get involved with that. Another example here. Very similar, different day, very similar. Oscillating around the VWAP, not so maybe so pronounced, but we've done trade to the downside, trade to the upside. Again, coming into the last sort of 30 minutes, 90 minutes, you get some ignition bars pushing down to the VWAP. There's some scalp opportunities there. Didn't quite touch it, but it's that magnet effect. And it's a thesis of we're not getting too far. We're not really a trending day. Yeah, we've done some trade above the VWAP, but if that's considered value, we're probably going to go down and touch it or at least get close to it. Another example where the trade just didn't, I think it was valid. It was great. And I was alerted to it. Yeah, I want to trade this, great. But the trade was taken away from us. In other words, US Open oscillating around the VWAP, push lower, start to come back up. And it was at the VWAP with 30 minutes to go. So there's no trade. So it's easy to say, I don't want to take the trade. Now, if we'd shuffled that chart an hour along the x-axis, so sort of this point in time, we saw this ignition bar, and maybe it was, didn't mean to do that, this ignition bar here, and it was maybe 8:15 or 8:30, then great, the trade's on, and it's pushing back to the VWAP. So you've got to think a little bit strategically about how to position for this, and if you want to position, but the broad thesis, broad idea is VWAP acts as a magnet, pulls price back under the right conditions. And if you use that as your North Star, you can build scalping strategies from that. Hey, I want to scalp that move back up. Hey, I want to scalp the last little pulse. Hey, I want to kind of buy ignition bar high, look for a couple of minute move. You know, that's the way to kind of approach it, in my opinion. All right, so last point to make before we go to Q&A, and this is kind of a point that might take us a bit of time, but it's worth it. So how do you get good at scalping? I've shown you some examples of strategies and stuff that you can look at and kind of go back and reverse engineer and look at the charts and the other good stuff. And we absolutely should do that. We need to do that because trading is a game of experience. It's a game of screen time. It's a game of discipline. It's a game of getting up and not getting disheartened. It's a game of doing what needs to be done to get where you want to go. So how do we kind of amplify that? How do we accelerate that learning curve? So repetition and training drills, just like any other endeavor, are the key to kind of getting good at scalping. So repetition, fine. We're trying to look at certain levels, and we're maybe getting involved in some scalp trades, doing some small scalp trades, just getting good at stuff. But one thing you can do with these drills. So one thing I didn't mention, actually, I'm sure I had it on the slide, was market depth, yes or no. So a lot of people say, right, if I'm going to scalp, do I need market depth? And my answer is no. And why I say no is this, and this is someone from 10 years ago, market depth was just I had to have market depth, had to see the level 2. Market depth, I'm talking about the price ladder level 2, dome, whatever you want to call it, seeing the underlying book. And people say, okay, yeah, I need to see that to kind of see what's going on. I would say years ago, yes. But now the algos are running amok there. There's so much noise. If that's an edge you've developed, then fine, but I don't think it's necessary. However, I had a chat with a trader. It was interesting. We had our Traders Mastermind annual meet the other day. Went to a beautiful 5-star hotel in London. We had some food, had some chats, some trading chat. And one trader was saying, listen, yeah, I agree with you not to use market depth. Maybe we don't need it. But understanding what's going on under the bonnet gives you better ability to trade. If you're trading a CFD product, if you're trading the spread bet product, you're just looking at price, it gives you a better understanding without having that noise. So a good suggestion is to maybe go watch some YouTube videos on market depth, understand what's going on, and then go, right, I understand what's going on under the bonnet. I know how a trade transaction takes place. I know what liquidity vacuum is. I know this stuff. Right, now when I'm watching price on my chart, my 15-second chart, whether you're say spread betting or trading the CFD, Fine, I get it. I understand why price moves quickly, the pace of the tape, all this type of stuff. And so now you watch the ticker at key levels and you say, right, how does price move around the open? You know, how does it oscillate around the open? How does it oscillate around the close? How does it react to the prior high low? And you're looking for things like the pace of the tape, the pause in between moves, the extension of the bars, all these subtle clues that no one else is looking at. Guys, there's traders out there that haven't got a clue what's going on. They're watching the market, they're using textbook stuff. You don't want to be that guy. You don't want to be that guy because you're going to get results that all the other guys get. You want to be the guy or girl who is really understanding of supply, demand, imbalance, and structure. And even if you're not looking at market depth, which I don't recommend, and that's a personal preference, you understand how price is moving, why price is moving, why we get these extensions, why it kind of snaps back, why VWAP is a magnet. This is the extra element of edge that you can develop and carve out, so that when you take a trade, you feel comfortable and confident pulling the trigger because you know what's actually happening. You're like, why the, you know, what is that doing that? That's doing that because institutions feel like that's a good benchmark, and actually they've got a load of people who are price sensitive there and it's not moving, and now they're time sensitive. Okay, so that's creative, and you can really piece together why something's moving. And if you're a trader who goes, well, why is this working? I don't understand that. Then maybe digging into this and thinking and watching price structure, even if you don't become a scalper, even if you use it for a day trade or swing trade, recognizing that you're trading against other participants. These charts we have are all very beautiful. They're all very nice. They're all very sexy. They look great, and I'm really appreciative to the companies that do it and enable us to, you know, have these great charting platforms for nearly zero money compared to many years ago when you pay like 500 or 600 quid for a basic price feed. It's a great time to be a trader. But understanding that we are trading against a counterparty, we are trading against a group of other traders, and our job is to position when they are positioned incorrectly or when the crowd is running. So if it's a trend, we want to get involved. When they're wrong, we want to fade it. And if we constantly think about that rather than lines on a chart and pretty patterns and stuff, it's a it's a really better way of thinking about trading. Who are the participants? What's the supply demand imbalance doing? Why have we suddenly spiked? Why have we done this? And it doesn't happen all the time, which is why I'm saying to you now, drills at specific levels. When market's chugging normally, there's no supply demand imbalance. There might be a little bit, but it takes nothing to move it. We don't get involved in that nonsense. We want to get involved when there's extreme supply demand imbalance, even on a short term. So look at the open, look at the close, prior high and low, the current high low open. I've mentioned the open twice there. Gap fill, so prior close. Before, during, after news, how does price respond? These are levels that everyone watches. And if everyone watches it, great. I'm interested because I'm stalking what other people are doing. I'm interested in what they're doing. What are the big players doing? What are the retail players going to get stopped out? What's going on? Because that's where our edge is, where other people don't care about the price they execute at, or we have a massive crowd that is constantly driving the price in a trend. That's our edge. And the sooner you can switch your mind into thinking like that, I believe that's a much better approach than looking at lines on a chart. Nothing wrong with lines on a chart. They're there. I use charts, of course I do. But I see an extra element, an extra layer. I think about an extra layer. And many of the great traders out there do the same. They're looking and they're understanding people are trapped here. They've got to get out a very small door. I'm going to join this move because a lot of people are selling this. Or that was a little stop run, a liquidity hunt. Let me get involved in that. Or we've got an actual magnet. Price is obviously going to trade, obviously never say that, but is likely to trade back to that level because of X, Y, Z, because of institutional involvement, because of dates coming up. All this stuff is, if you notice, all the things I've shared with you are all based around that theory of knowing what other participants are likely to do. Do they always do that? Of course they don't. But if we can have a little bit of extra edge by saying, hey, you know what? Who the hell's going to be buying massive amounts of this stock or massive amounts of this market before a big data point? No one really. Okay, so if we extend away from VWAP, we assume VWAP's the mean. Is it likely to come back? Probably. Okay, what about, so you start to add these things in, you're thinking about your participants and who's on the other side of the trade. Gone off piste a little bit there, but hopefully that, you know, highlights a little bit about the thinking that I think is required in this game. And don't watch price all the time. It just burn you out. You just go crazy. You know, you can make a man go crazy by putting it in front of the screen and telling him to watch price just moving up and down all day long. And you might be like, yeah, but Mark, I do that. I watch price all day long. Just stop doing it. You need to keep your focus on the points that matter. You know, we're hunters, we're snipers. We're not just cracking off rounds here and there and everywhere and hoping something sticks. We're waiting, keeping our energy up, keeping our focus up. Price is coming up to the prior high. Okay, I mean, watch, focused, zoned in. You don't care about any other stuff going on. I just focus on that price. Tick, 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 tick. I was running through quick, pausing. There's my entry. I'm in. That's gone against me. I'm out. Okay, right. Or come back. I'm out. That's the way to focus it. And it's very intense. So really do it at the key levels where other participants are interested. I hope that makes sense. Okay, so what are we looking at? How long we got? 5 minutes until Q&A. Perfect. Timing's good. It's not bad. Observe these metrics, guys. Pace of the tape. So pace of the tape is, again, we're not talking about market depth here. We're talking about how price is changing. And I had a slide a couple of weeks ago, gave you an example of if we're going from 10 to 15, is it 10, 11, 12, 13, 15, or is it 10, 10, 10, 11, 12, 11, 11, 12? You know, there's a lot of difference. And watching how price moves, just watching the price, forget about the chart, just watch the price running up, how quickly it runs up relative to prior moves. That's the difference. Because again, not sound like a broken record, I do hope I'm not, but what does that mean? It means that someone wants to get in quickly and there's enough volume there for them to move price, leaving a little bit of liquidity vacuum, because in the order book, there's no big players stacking up, so very often it's going to snap back. Range of the moves, how big are the moves around these levels? Time between these little bursts. So breakouts, you get a push, you get a pause, a push again, a push again, a push again. Sometimes it's push, 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 and then it stalls, and then it snaps back. Other times it's one big shove and back. Other times it's push, hold, holding level, waiting to see if other participants are there. No other participants, right, next leg. And think about again what someone's trying to do. Institution trying to buy. They're moving the market higher. Market pauses. Wait, hold. Don't buy anymore. That's what the algo's saying. Don't buy anymore. Wait. Just rest a bid. Rest a bid. Price is coming. It sits there. That's why we see these drives very often that sit above highs, because there's a resting bid there, or a bid that's trying to get, because they don't want to pay up sometimes. Sometimes they're doing it because they're just literally, I need to get in whatever the cost, and that's great for us. But sometimes they still need to pay up. They still need to get the trade done. So they'll pay up, they'll wait. Is any sellers coming in? Damn, there's no sellers coming. Right, step on it again. The algo then goes into aggressive mode. It flicks and it starts lifting off. So that's where we get the breakouts. So understanding this really helps you kind of train your mind and calibrate your trading to those conditions and to the conditions that are in front of you at the time. So time between pace bursts, general response to levels and times. And you can use things like screen recording software, replay function to help you with this. Okay. Some of you still here. Good. A summary. So getting an edge in scalping takes time. Watch, observe, make notes, look for repeatable patterns. And the short-term inefficiencies exist when, I'm a broken record, I know, and let me apologize, but it's worth thinking about. When the time and not price sensitive, you can identify those zones. That's where the scalper's edge is. And the better you get identifying those, the better your scalping will be. And it's as simple as that. Okay, so we've got a bit of time for Q&A. If we have any, I will have a look. Oh, geez, this is a few questions coming in here. Robert reads, okay, Mark, do you think the closing dance VWAP trade works better with US indices as the US markets can be driving sentiment during the, yes, 100%, Robert. I didn't say the question, apologies. And you guys can't see these questions, lucky for you. There's a lot of nonsense here, but Robert's got a great question. Mark, do you think the closing dance of VWAP trade works better with the US indices as US markets can be driving sentiment during European closes? Absolutely, spot on, 100% correct. I wouldn't want to be deploying it at 4:30 UK time on the DAX or the FTSE, because I just don't think that it's driven by that. Like you say, the US, as soon as the US starts to open, that's driving the European markets, unless they're on their own for some whatever reason. Absolutely, quite correct. I wouldn't want to deploy it during that period of time at all. Barry, good stuff as always, Mark. Do you use auto-anchored VWAP or do you set it yourself? Also, do you use the standard deviation of the VWAP to gauge the move away and potential reversal? Thanks. That's a great question, Barry. I use both, actually. So I like to look at the 24-hour VWAP if I'm trading, obviously before the regular trading hour session opens. But then when we open, I will anchor a VWAP at 2:30 UK time, and then that then becomes my main kind of focus. Often they're in sync, but often they're not. And so I will probably anchor the VWAP. I will, not probably, I do anchor the VWAP at 2:30, which is the open for the US indices. But if you're trading the currency pair, then find the 24-hour VWAP. The user auto anchor. So yeah, the one on TradingView, I'm not sure what platform you use, Barry, but the one on TradingView is a 24-hour one, and it just kind of actually no, it's not always. If you use SPY or Qs, it does anchor at the open for you. But if you're trading the CFD or looking at the CFD product, it's a 24-hour VWAP. Fine. I will set it and I make sure it's anchored at the open, and I will start to shift my opinion of what the VWAP is to that anchored VWAP at the open as we start to trade through the open. Also, do you use the standard deviation of the VWAP to gauge the move away and potential reversal? You know what, Barry? This was a strategy that was quite effective. And actually, if you go to Traders Master, if you haven't got this already, you can download a tool. What did I call it now? I think you remember, Barry, aren't you? So I will give you a link to it. But it's a tool which uses that kind of bands. And the idea is that before data or before the open, you're like you're saying, you're trading around the standard deviations of the VWAP, and you're shorting at the upper band, you're closing at the VWAP, and that's very effective when you have a morning after trend day, when you have data coming up, when you have the expectations of a range bound day. So yeah, that's something to definitely consider. But I would use it in conjunction with a trigger. So what do I mean? So VWAP's there, you've got your standard deviation bands, it comes up above the kind of first band, great. Filters ticked, you've got a range bound day tick or expectations of range bound day ticked. Now you need an additional trigger. Is that an ignition bar back in the direction of the VWAP? That's good for me. Is it an exhaustion bar after a big move? That's okay for me. Is it a little double top and a wick? Good for me. So those little things like that, I think in combination with that standard deviation band are useful. I don't think that just shorting blindly when it hits the standard deviation band is that good. I could be wrong. Maybe there's a strategy to deploy from that. Just thinking about conditions here, but I like to have that additional trigger personally. But that's a good question because those VWAP bands are pretty decent. Okay, Mark, how are you doing, Mark? Hi, Mark. When using a fib in your example, what time frame are best to use? It kind of doesn't matter, Mark. But as we're scalping, I like to use a 30-second chart or a 15-second chart. Wait for the market to run 30 seconds, 1 minute, 2 minute, get your fib in, get the high in, and then it's still going to be the same if you're using 15-minute chart. We wouldn't want to do that, but it would be the same, right? Because you still have your high and it will come back 75% of that move. You're staking the high and the low of the kind of first 5 minutes of move. After that, you maybe don't want it because you want that knee-jerk reaction. 5-minute move, 3-minute move, perfect, come back. So 30-second chart, 15-second chart, perfect. 1 minute if you want, I think that's okay. Anything higher than that, unnecessary. You probably want to go down a little bit, but it's the same type of thing. You're still going to, what price is price, and still retracing 75%. But for visual purposes, I'll drop it down a little bit. Okay. Frankie Gertz, are you using 1 minute or 5 minute time frame for scalping? 5 minutes to get your view of where the market is and to draw your attention. So market's approaching highs, market's approaching lows. 5-minute chart is great because it gives you a good kind of 2-day view, right? You can see the prior high, you can see the prior low, you can see the prior close. You get a good picture of where we are in a 2-day kind of cycle. And then as price is approaching the level, that's when you switch to your lower time frames. A minute I think is fine. Do you want to go lower than that? Yeah, you could use a 15-second. If you kind of want to be aggressive scalping and the opportunities there, great. But I think the trick is, Frankie, is to keep your kind of seat pushed back on a 5 minute, so you're not getting sucked into any kind of chop or any action. And then when the price is coming to the level that you think there's going to be that imbalance, you think there's going to be that sensitivity in terms of time, not price, right? I'm activated. the kind of red button trigger's been lifted, or the red button cage has been lifted. Now I'm ready to trade. Let me go down to 1 minute. I know where I am. I'm calibrated to my direction. I'm calibrated to my position. Okay, I'm going to trade another 1 minute or 15 seconds. What am I looking for? I'm looking for exhaustion. I'm looking for this. I'm looking for that. So it's that constant myopic view and then back out and kind of trading in that way. Okay. All right. Barry says, that's great. Thank you. I think I've covered everyone. Thank you so much, ladies and gents. Yes, good timing. Okay, so that's it for this year. I hope that you found some value from these webinars. I've enjoyed presenting them, and I've got some great questions, so thank you for those. If you want to watch any recordings, you can do on Traders Mastermind /webinars, I want to say, but top right, if you go to webinars, they're all there. This one will be uploaded pretty quickly. And keep safe in your trading, keep the risk managed, and I shall see you very soon. Take care now. Bye-bye, guys. Thank you.